Okay, hey everybody. So bullish day, 1.25% up in the E-minis. We're up almost 2% in the NASDAQ. We are in a bear market. I have called it. It doesn't mean that theoretically we're down 20% in this correction, but we are in a bear market. Now, if you'll recall, what we did is when we were doing our program that I've not written all up yet, but you remember one of our permissions was if the SPY, and even though we may be in TQQQ or we may in something else, if the SPY price closes at the end of the month below its 200 simple daily moving average, then we have permission to get out. So what I wanted to show you today, you may have heard this in the last couple of days. What this is referred to as the death cross, right? And this is SPY. You see our linear regression model shows us that we are certainly in a downward facing trend. This is a daily chart, and this is the 200-day moving average, this one here. And this one is the 50-day moving average. And what you can see is the 50 has crossed down below the 200-day moving average. Now, I'm no technician, and I'm not necessarily a believer in all that much technical analysis, but what this confirms to many technicians out here is that we're definitely in a bear market. So the 50 is below the 200. That means the acceleration to the downside, since this is a shorter time frame, we are now accelerating to the downside. So again, we have permission in our plan to totally get out of our UPRO and our TQQ once we're below the 200 at the end of the month. At the end of February, we were down. I am seriously considering it, not because I'm scared, not because I'm fearful, but I just know I'm thinking it may be a prudent thing to do, to step aside for a moment and to allow us to work on trades that are doing a little better. Let me mute everybody. Yeah, so that's the thing. I'm thinking that we may do something where we get out for a moment until we get back above the 200 daily moving average. And the reason is we're going to take pain. Remember the study that we showed you was that there are more areas of significant downside movements when you're below the 200 simple moving average. And it doesn't matter if we were in TQ or UPRO or whatever. So I may step aside. I very well may close those positions. I may up my positions in some credit spreads, may up my positions in some different things like the 111 trade, because the 111 trade has been the greatest thing that we've had going on, even in such a turbulent market, which has worked out really, really well. So let's see. With that being said, let's look at our volume profile, and let's go to the E-minis. And Beth is in here from my class, from my Alabama class. And Beth, I appreciate you being here. Our Alabama class is on spring break this week. So Beth, if you're here for class, it's a little different today. This is just my regular trading class. And Beth and I got Beth in the gym today, y'all. How about that? Sweet Beth has some sweat coming off of her today. And look at my brand new red shirt. Look at this. I got one of these skin tight shirts. It makes my pecs stick out. Oh yeah. So anyway, got Beth in the gym. And then we had to go to the Ruby Tuesday. And then I'm not going to say whether or not I stopped by the donut shop and got me a donut or two. I'm not going to say that at all. So check it out, y'all. On the E-minis, what happens is we bump our head. Look at this. We expect this area, our 120 line on our big green monster, to be an area of resistance. What does it do? It does what the big green monster does, and it held off price. So now price has popped back down into what we call a fair value zone. Where do we anticipate price to go? We anticipate price to probably head back down here to the 50% line. This is resistance. Resistance. Popped it a couple times, could not break it. And what is it doing? Indeed, it's falling off that, which is really, really cool to see. All right. How many times do we see this, by the way? I mean, we draw this thing, you know, what, 14 days ago? and it gives us levels that are even working today. So no surprise here that we talked about the death cross. We talked about how it may be prudent, since we're in a bear market, to move out of our TQs and our UPROs until we get back above the 200 daily moving average. May be prudent. I may do that. It's one of those things that I was thinking about it last night, and I go, God, well, do I want to do that? Do I want to do that? I don't want to do that, but it may be the prudent thing to do. So we'll see. I could easily do that. In the meantime, what would I be doing? I'll be doing a lot of 111 trades. I probably do some Rick trades to continue until we get back above that 200-day moving average. Again, I am solidly of the belief that we are in a bear market. I want to show you this too. I think Dr. Our friend posted something in one of our options trading rooms. I want you to see this. Let's see if I can see this. All right, so if you get a 20% down move so far, we say that we're in a bear market. Let's see if I can find it here. Tasty trade options. See if I can find this. Hold on. Hold on. Oh, and I start with my personal trainer on Friday, y'all. I'm so excited. I'm doing an hour of personal training every week. And I basically told my little trainer girl, I said, look, girl, I'm going for Hugh Jackman. That's what I'm going for. And so I showed her the picture that I'm going for. So we'll see if she can pull it off. I said, let me tell you something. If you can pull this off and you can make me look like Hugh Jackman with his shirt off, I said, girl, you're going to be a bazillionaire. Plus, I'm going to teach her to trade as well. So it's going to be fun. She's teaching me fitness and I'm teaching her finance. And she's already started out really, really well because she has no debt. She's 24 years old. She's got, where's the Dr. Joseph? Let me search my little room here. He showed this nice little graphic that we're already in a bull market, in a bear market, in a couple of things. I think in the Russell, we're not quite there. We may be there in the Qs. Let's see. Where did I search this thing? Here we go. Joseph. Let me search Joseph. Dr. Joseph. How come I'm forgetting Dr. Joseph's name now? Joseph. There's Tom King. There's Jim Wilson. Anyway, I can't find it. What if we did this? Let's go this. Let's go Yahoo Finance. Finance.yahoo.com. Let's look at the SPY. What is the SPY down so far year to date? It's like 12% down, right? Let's see. SPY date. I don't want no gift. Let's see. Historical data. YTD. Here we go. YTD. SPY is YTD daily total return down 12.26%. Okay, so for us to truly be in a bear market, that would be what, 20%. So let's look at IWM, which would be the Russell. The Russell Y to date is 12.43. I thought it was more than that. Let's see what the Qs were. The Qs are down 18.6%. So that's right at the 20%, right? That we would say, hey, we're definitely in the bear market for this year. What's the other one? Diamonds, which would be the Dow. Diamonds are down. I said the diamonds are down 10%. Okay. Nonetheless, I believe we're in a bear market. I believe we're at the beginning of a bear market. We just don't see it yet. So it doesn't matter if y'all guys think that like or not, it's just kind of cool. Okay, I wanted to join for your market perspective on the market free flow. Oh, awesome. Work call at 1. I have to get off and join that. Okay, good. All right, Beth. Well, what will I enjoy? Oh, you're talking about the working out thing? I hope so. I've been getting up at 5:30 in the morning Eastern time, even on the even yesterday, right, with the time change and everything. So it's been going, so far so good. We'll see how we like it. All right, so that's my opinion on the market. We are in a bear market. It may not be confirmed by being the 20% down, but we're going there. And what we're seeing is, here's the thing, every rally, right? We see the high here, every rally is being met with, it's an area of resistance, right? And we're being pumped down. And then we go up and then we pump down. And we go up, it's being pumped down. So we pop back up, we go back down. We pump back up, we go back down. So what you're seeing here is you're seeing lower highs. Let me draw that for you. Everybody see it? We have lower highs. See, this is a high. Now what's this? This is a lower high. This is a lower high. This is a lower high. And we got one higher high. And we got a lower high, and about the same high. So we've got a series of lower highs and we have lower lows. Here's a low, here's a lower low, here's a lower low, we got a higher low, a little bit lower low than that one, and then the lowest low of all. This to me is bearish, bearish. And as a holder of TQs and UPRO, some of y'all have already built, right? Some of y'all have already said, I got the heck out of here a long time ago. I understand, and I see why now, because I am clearly convinced we're at the beginning of the bear market. Yeah, just my assumption. Now, for that assumption, then I'm going to have to change some things. So to change some things, I'm going to change the core of what I'm holding. Now, what I told you I wanted to do, though, is in the portfolio, I don't want to tell my spreadsheet that I'm selling, because indeed, I want to buy more after we complete the bear market, you know, as we get lower and lower and lower. I'd like to buy more UPRO. And so I don't think I'm going to tell my spreadsheet that I'm selling out of my positions. But at the same time, I'm fully convinced we're going lower, fully convinced. Now, remember what the market does. The market is here to confound the most people that it possibly can into making the total wrong decision. And I've made the wrong decision definitely for the last few months. I've been on the wrong side of this. So at the same time that I say that we're in the bear market, wouldn't surprise me as everybody's bailing to see the thing just rip again. But what we'll do is we'll wait until this thing gets above 200-day moving average before we make the bump back in, because we don't want to do it until we're confirmed back into normal times. And what we're seeing now is anything but normal. This is very, very abnormal. This is what you do not normally see, and we've not seen in a while. That's why I say it's the beginning of the bear market. Now, I could be totally wrong. We could still be in the bull, but I think, and I'm not just going by the death cross, right? I just know that a lot of people are referring to the death cross today as something that a lot of technical people look at, and that's fine. All right, so that's kind of the plan. Let's look at our skew driver for the day. See what our skew driver's saying. So we're going to go out to 414. That's 30 days out. Look for the $20 SPX spread that is trading for $5.20, and we know that it's 150 points away from the market. So let's put that in so we can track our skew. So skew on an update is certainly down, but it is still at a unbelievably high level, right? And we expect skew to normalize. The only problem is when. And this is not a good timing pattern. A lot of times it is, right? You can say, man, skew gets up here, it's going to immediately revert back to the mean. It has been bid for some while now and shows no indication of getting back to normal times. And again, all of this stuff is further confirmation to me, even though we think that the market should go up so that skew normalizes. I got no idea when that'll happen. I mean, it is staying out here for some time. Another indication to me that we are in a bear market. We are in the beginning stages of a bear market, which is good for the market, actually. It's long overdue. All right. Now, we also talked yesterday about this is not the time to be putting on your VIX hedge. This really is not the time to be putting on your black swan hedges. during this period of increased volatility. The volatility is bid. What is VIX today? What's VIX trade? Let's see. VIX is still above 30, I would imagine. 30.83. All right, so VIX is still tremendously high. So we can't do a VIX hedge. I'm not even certain that it makes sense to do Black Swan hedge at this point. So what can we do? What we've got to do is in this period of time where every rally is being met with resistance and every rally is getting sold off, then we need to sell into those rallies. That's what we need to do. And the biggest thing that we can do now is to keep our size small, right? We don't want to oversize our trades. We don't want to put on too many trades. We just want to keep things nice, slow, simple. And the best way to hedge in this type of market is to do defined risk trades and to keep your positions small. You don't want to do tons and tons of large risk to the downside. So let me open this other account, see if I can open it and see what we're doing there. We might build out another 111 trade, which has been the greatest trade on the board. Everything else has really underperformed that. So let's see how we're doing today. Oh man, come on. 111. Come on, baby. Come on. Yeah, and I've got me a knee brace for my knees. And I can't hardly feel my knees right now. I've worked out so much today. I'm like, oh my gosh. Make sure this doesn't show account number on it. Good. Show the account number. All right. So let's see if we can build out our 111 for the day. I like making this our daily trade. You remember we used to sell a micro daily. I like doing the 111 trade daily, or we can do a 112, whichever one we'd rather do. Now, how come it's not showing my positions? Make sure I've got my positions shown because I don't like to double book trades. Let's see, trade, show positions. Okay, it says show positions. Do I not have any positions? So let's go out 45. Oh, there they are. There's my little dots. So let's go out 45 days. Let's do a 1-1 trade. So we're going to do a long put vertical. And we're going to make that 50 points wide. There. Right? 50 points wide. And we're going to move that down to a point where we can buy that for not $18, but we're going to buy that for $10. So we're moving that down, moving it down. That'll get hung. We're going to move it. Hung again, move it. 50 points down. So we're at 1425. We're moving. Everything looks good now. So now we're at $13. Debit. Move it down. There's 12. It's hung. Move it. Down again. $14. Oh, it got hung. $11.50. And we're going to go down to about $9.75, and then we'll work it to $10. 50 points. I hate it gets hung up there, so we'll go in one more. So I would not go here though, because I don't want to sell one where I've already bought one. Everybody see that? So maybe I could go down one more. It's fine to buy one where I've already bought one and to sell one where I've already sold one. Everyone see that? So we'll bump that up to $10 to see that we'll get filled. And we're filled. Da-ding, da-ding. So now we want to pay for that. It costs us $10. So we need to sell something that we take in at least $20 to pay for that. So we could go to the 35.20. It has a 10% probability of being in the money. Or if you sit there and go, I don't like those odds. I mean, that's, in this, you said it's a bear market. You just showed that the chart was bearish. So you say, let's get further down. Okay, so we could go down here, right? And we could say we could take in $26 by selling 2 of the 33. And it looks like that gets us, looks like this is the 2 standard deviation line. So we could go down here, right, and sell 2 of those. We bought that for 10. So we'll sell this. That'll give us $26. Now, let's see if we can sit on the curve. See that we're down there at 2 standard deviations out of the money. Let's see what that looks like. We're down here, right? We're selling the 3,300. So it looks like, what is that? 1 standard deviation. Let's go down to 2 standard deviations there. See, we're just outside of 2 standard deviations. Let's see if I can get all that on here. All right, so let's try that. Let's sell that. That's going to take $700 of buying power, and we have it. Fail, but we're failed. So what was that trade? That trade is a 1-1-2. So we're buying a put debit spread, which is a bearish trade. And then we're financing that by selling 2 naked options to cover the cost of it. But we are very, very safe. We're at 2 standard deviations out of the money, right? So what is that? 1 standard deviation is a 68% of all occurrences occur within 1 standard deviation. Within 2 standard deviation, 95% of all occurrences occur within the 95%. So we're at a, what was it, a 5% probability of being in the money. Delta of 5, 6%. That's how you calculate it. Because 95% of the time, price is going to fall within the 2 standard deviations. So we're just beyond 2 standard deviation. So we basically have a 6% probability of being in the money. Now, let's make sure everybody realizes, what is a 6% probability of being in the money? What does that equate to as far as the probability that price of the underlying line or of the micro E-minis, what is the probability that price will touch that strike? So if we have a 6% probability of being out of the money, all you got to do is double your probability of being in the money to get your probability of touch. So as a back of the envelope way of saying, hey, what's the probability that price within the next 45 days will touch my 3,300 strike? 2 times 6% is 12%. And that's just back of the money. Now you can change this to go, let's see, probability of touch. Here you go, touch percentage. See, 12%. I didn't lie to you. So the probability of touch is 2 times the probability of it ending in the money. Let's go back to probability of being in the money, 6%. What's the probability that price of SPY, or of the micros, which is currently at 4,221, will get down to 3,300 in the next 45 days? Probability of being in the money, 6%. Probability of touch is 12%. Isn't that cool? All right, so you know the probability. So what it tells you is there is a humongous probability that that's never going to happen. So what we could do is close these trades once we have enough profit to fully pay for the put debit spread. Let's see if we can look at our little fortress here that we've gone up, and why we like this trade so very much. Do you see that price right now? We are in the profit zone of our micro trades. Look at this. We're in the profit zone right here. All you see is green. Now, what happens if price goes up? Remember, we put a couple of these on the call side. Remember, on big days up, we put a couple of these on the call side. So if price goes up, our profits are not just level, but they increase a bit. Now, we get that in exchange for what? Well, we do have probability that we could lose if price were to go beyond our break even, right? But again, Everything I showed you, we're in a bear market. I'm not really worried about these at all. Now, what if price goes down? Well, if price goes down, we go hooray, hooray, because we have a humongous profit hump to the downside. So if anyone's wondered, why is the micro 111 trade your most profitable trade? Well, because I make money here, I make money here, I make money here. And look, I mean, we make money all the way down to the 3,300, or down below the 3,300. What's my break even here? The 3,270, 3,270. What's the probability that price hits 3,270? Let's see, 3,270. What's the probability that it's going to touch that? 12%. What's the probability that this is going to end up in the money? 6%. I like those odds, even though we're in a bear market. Now, the cool thing is, what happens if price goes down tomorrow, right? What are we going to do? We're going to put on another trade, 111 trade to the downside, right? So that we're moving this profit zone, we're constantly moving it by putting on new put debit spreads, and we're moving our hump kind of downward, right? So we're popping this down, popping this down. Now, some of you have been asking for an exit criteria for the 111 trade. Bobby, what do you do if it goes against you? Well, here's the thing. I hadn't had one to go against me yet. Well, Bobby, how many have you done? Well, about 70 of these things, and not one of them has lost money. Now, we're on a big time roll with our 111 trade, but even in this chaotic, strange market that we're in, 111s are doing great. They're just doing great. So remember, and I will reiterate this, there was one batch of 111s that I almost got into a little bit of trouble on because I took them to expiration and I was going to have to roll the naked component, roll that naked put, the far out of the money put. I was going to have to roll that out in time to extend duration, to give the trade a longer time to work. I was going to close those at a loss. However, that didn't come into being because the market rallied up. I was able to take those off at expiration. Oh no, my connection has dropped. Y'all still there? I was able to, okay, now we're coming back. I was able to close those all at winners. So the takeaway for me from that instance was, hey, Bob, you need to close those puppies probably, you know, at least start thinking about closing them around 21 days to expiration if they're profitable. Probably don't let them go closer than 7 days to expiration, which seemed like a perfect way to execute that, the closing of that trade. Or if you're using it just as a hedge, you know, close the short naked component as soon as this is 50% so that your put debit spread is on for free. You've got a hedge trade on for absolutely free, which is kind of cool. Looks like I'm having some internet connections, so I apologize about that. Okay, questions on that? So that's the 111 trade. That's why the 111 trade is so powerful, is it gives us a wide range of area to be profitable, whether it be to the upside. And again, I didn't have to do any on the call side. If I didn't do any on the call side, it would look like this. You don't care how much the market rallies, you're going to make X number of money, right? Of course, I put a couple on the call side. Just seemed like a prudent thing to do it if we're in a bear market, as I believe that we are. But even so, the put side 111 trade has just been absolutely phenomenal. The 111 and the 112, absolutely phenomenal. As a partial hedge trade, grind down to the downside, as well as an income trade. And I will continue putting these on daily. Right, but I'm going to reflect on what I'm going to do on the other things. I'm thinking, my thought process right now, maybe y'all can correct me and say, Bobby, that didn't sound right. It's to close my UPROs and to close my DQs. And today's a good day to do it when the market is up, because I fully believe that this rally today is going to be beat down. Maybe beat down by the time the day is over, who knows? All right, questions on that? Questions on the 111? Why it's the greatest trade in the bag now? It is not the all in all, holy grail of trades. It's just a good, resilient trade. That's what it is. And in this turbulent time, we've got to make sure we just stay small, stay smart, and don't overdo it. All right. Good session, y'all. I hope you have a great day. I will see y'all tomorrow.